Welcome, everyone, and thank you for joining us today. My name is Sasha Moore, and I'm delighted to moderate today's webinar, Growth Strategies, How to Use Trail to Scale, on behalf of Trail Homes, Australia's most established and leading trail book company. Today's session is a sequel to the recent Trail Book Masterclass and Smart Succession Planning webinar, where we're actively shifting the conversation from viewing Trail as a linear passive income to exploring how, when structured strategically, Trail can become a powerful source of capital growth that helps brokers to scale faster, improve cash flow, fund acquisitions, invest in people, and create long-term enterprise value. On this note, today's event is designed to help brokers better understand what to expect post-budget from an accounting perspective and obtain some practical guidance on the tax implications that can materially impact business. We're also going to look at how to identify whether your business is expanding, maturing, or in decline, and why this matters for your trail strategy. Again, looking at the tax implications for that as well. We're going to explore how a trail book can be utilised as both a strategic asset and an alternative debt facility to support different stages of your brokerage's growth. And we're going to unpack some of the corresponding ways that trail can be monetised, including partial sales, equity strategies, acquisition funding, and growth capital structures. Today, we're joined by industry veteran and trail book specialist Nick Young, founder and managing director of Trail Homes. Welcome, Nick.
Hello, Sasha, and good afternoon to everyone.
Great to see you, Nick. Nick will be joined by SME accounting specialist and business advisor, Justin Mastoris from Rees Group. Welcome, Justin.
Welcome. Good afternoon, everyone.
Good to see you. And we also have the privilege of receiving commentary from Trail Finance specialist Angus Young. Welcome, Angus.
Thank you for having me. Good afternoon, everyone.
Good to see you. So we want today's session to be as practical and interactive as possible. So please be sure to send through any questions you have for the panel via the chat function or through the Q&A function, and we'll either schedule those throughout the webinar or address them at the end. So let's get cracking. Justin, I'd like to start with you though, before we delve into all of the strategies associated with trail and growth. Let's just do a quick regroup on what's expected post-budget, because I understand that the implications are quite substantial.
Okay, thanks, Sash. So I firstly want to start by saying there's a lot of proposed change from the federal budget, and we've already seen last week that it's a moving goalpost. So everything that you read about in May is constantly changing, and by the time most of it ends up as legislation, for political reasons, I think that the government will actually keep changing because they created some policy on the fly, which pretty much everyone in the room and everyone watching today will agree was a bit of a tax grab. So if we start off by looking at the capital gains tax changes, so the main one is the removal of the CGT discount, the 50% discount for holding an asset for longer than 12 months. So I'm old enough to remember back in the 90s, when I was working as a graduate accountant, you had an indexation method, and they're reverting back to this method that basically an asset that you hold for longer than 12 months, you can index the base of the cost base over time. It includes a business. It could be a business, could be a property, could be shares, and you can index that cost base over time. And then when you sell it, you essentially pay tax on the difference, but you don't get the automatic 50% exemption that we've essentially had for, I think, pushing over 25 years. So that's the main one. What has happened last week in relation to capital gains tax is the government realised they were cutting all of us, as in everyone on the webinar today, myself and business owners, out of the picture by not providing the 50% reduction on the sale of a business. And so they backtracked. I think it was number 2, but along the lines of allowing small businesses with essentially a turnover of up to 10 million to still get the small business capital gains tax exemptions, which mean you pay tax on half of the gain if you qualify for those exemptions. So that's the main one around capital gains tax, around all those assets. And everyone watching today would have read about the negative gearing changes from the 1st of July 2027. They're looking to only allow negative gearing on new properties, nothing existing. So what we're saying to clients, and you should be saying to your clients as well, is if they are going to be signing a contract, so it's the date of the signing of a contract, it should be before for the purchase of a property or a business before 1st of July next year. And you still fall under the old regime if you sign a contract for the purchase of an asset before 30 June 2027.
Okay, thank you, Justin. And we'll unpack as we move on how that relates to some of the strategies that we're talking to today. So let's start with some of the common traits of an expanding business, a mature business, and business in decline to work out first and foremost what stage of your life cycle your brokerage is at, because it's important to understand this first to then determine which portion of today's webinar is most applicable to your stage. So we might go to the graph, and Nick, I'll hand over to you. Let's go through the traits of an expanding business.
Thank you, Sasha. So I think this is going to be the only chart that we're going to be seeing today. So we better make it an important one, and it's one of my favourites, and some of you will have seen this before. So it's a very simple little chart, and it's meant to depict a typical mortgage broking business over time. So you can see the orange line there is the upfront commissions, and the green line is the trailing commissions. So as you all will have experienced, when you started your business, you have nothing, and you then start writing loans. And the first thing that starts happening is your upfront commissions start coming in. So you can see that on the orange line, and hopefully that grows over time. The trailing commissions take a bit longer. Same as everything else, they start at nothing and they start to build. Now, if you look at broadly the first third of this chart, and remember this is just a depiction of what's going on, you'll see that the upfront commissions are substantially higher than the trailing commissions. And of course, you'd probably say, well, when you're starting out, of course that will be the case. But as you then start to move into the middle of the chart, you'll notice that the two lines come together, and very approximately about half of the commissions are coming from trails and half are coming from upfronts. Now, that's not just the way I've drawn this chart. It was actually, believe it or not, the way that the whole system was designed, in that right back at the start, they looked at what an average line would be and effectively came to the conclusion that it would be a good idea for a mortgage broker, a mature mortgage broker, to get about half their income from upfront commissions and the other half from trailing commissions. So it means that for a mature broking business, you should be about equal. So you can all probably quickly do a calculation or think about your own or latest commission statements and think about whether your upfront commissions were higher, about the same, or lower than your trailing commissions. And what that will tell you is if your upfront commissions were higher than your trailing commissions, and they tend to be higher every month than your trailing commissions, your business is expanding, it's growing, and that's great. If they're approximately equal, it means you've broadly got a mature business, and effectively you're in the middle of that chart. Now, from the way I've drawn it, it's effectively a third, a third, a third, if you like. But that middle bit may extend for some period of time. And then the final bit is a business in decline. So this is a business where the trailing commissions exceed the upfront commissions. And if you think about a business going into decline, and particularly what I've seen, the upfront commissions actually fall away quite quickly. They fall away, in fact, much faster than they grew at the start of the establishment of the business. So you'll regularly see, if you like, I talk about goodwill, and that's a thing we spent quite a bit of time on in the previous session. The goodwill associated with the business is burnt up pretty quickly. In the space of a year, 18 months, you can burn up an extraordinary amount of goodwill. But the trails do kick on for a bit longer, but nevertheless decline. So the three stages there. Number one, where your upfronts are running higher than your trailing commissions, your business is growing, where they're about equal, mature, and then the back end when your business is in decline. And what we're really going to be focusing in here on today is people in that first third. And it's also how you keep your business in that first third, because if you can obviously keep your business growing forever, you're going to have a very successful business.
I love that. And Nick, one thing I did want to ask that you've just touched on is, in your experience, what have been the approximate time frames associated with each stage, or does that really vary brokerage to brokerage?
It varies dramatically. I was doing a valuation for a very successful business based in Gippsland, Victoria. And that business has just been growing consistently year after year. They're making acquisitions. They're bringing staff in as shareholders. They are just staying in that front third. You then, conversely, you'll see a lot of business in that middle bit. And, I see often businesses where, a mortgage broker will say, I write a couple of million a month. I've been doing it now for 10 years, 15 years, great. It's a mature business. It's in that middle bit. The sad bit is that business is in decline. They're the ones that need, action, one way or another.
Okay, thank you. Well, as you said, obviously with today being growth oriented, we'll leave that latter quadrant or that latter third for now. I'm just wondering, if I was a broker watching this now and I had that moment, well, perhaps my business is in a more mature stage. Um, do you find that mature stage businesses can still become a growth business?
Of course, of course.
Okay, so
You-
I guess
you-
from that, it's really looking at those stages, but also looking at how, if you do have the flags of a mature business, how you can be proactive in terms of the strategies to make that a growth business again.
Exactly. And one of the strategies is, potentially buying another business, and give yourself that, step up. It can also be bringing on business partners. There are all sorts of ways that you can energize a business.
Okay, so it's not like humans. Once you sort of get it to a particular age, you just keep going. So that's good news. That's good news for brokerages. So
Good.
we've talked about the characteristics of an expanding, mature, and business in decline, just more from an origination perspective. I'd like to also just get your take in terms of what type of personal characteristics that you experience with brokers. So starting with an expanding business, what typically is that broker like in terms of their mentality and their drive, and what are some of the personal traits of brokers that you sort of see in that stage?
There's an excitement about them. There's a want to grow. There's an inquiring mind. There is a drive. There is an energy. I mentioned that broker who writes a couple of $1 million a month, and I've been doing it for 10 years. You can see that they're very comfortable, and that's in one sense great. But it does mean the business is just writing $2 million a month, and that's what it does. It's that energy you have when you start out in life. It's the new romance. It's keeping it alive. It's keeping it exciting, and that's what you look for. That's what growth is about.
Fantastic. And so for, say, a mature business, when you've got sort of that equality of trail income and commission, so how would you sort of say a mature business is more looking in terms of their traits?
Well, as we've touched on, it's about a business that is comfortable with itself. It's happy with itself. It's returning phone calls, but it's perhaps not being as proactive as it once was. It's not, they talk about wearing out the shoe leather. The shoes are actually being quite conserved. It's a business that is happy to be what it's doing, trundling along, very comfortable in its own skin, but it's not really looking to grow any further. It's not looking to do anything different. It's not willing to explore. It's just keeping pace and keeping on, as opposed to being that young and exciting, growing business.
And so I guess to that point, it's really a mindset piece. It's what brokers want for their business. And again, there's nothing wrong with any particular stage. I guess as long as you're making the decision of, or you have that awareness of what stage you're in, and then consequently you're acting to both maximize your interests, maximize your long-term interests, but also how you go about that next stage. And particularly, I think, Justin, I might throw to you, just in terms of those three stages, and we'll obviously go into in much further detail. But do you have any, if we just go back to a newer and expanding and a growth stage business, do you have any initial comments from an accounting tax perspective?
Yeah, I think when a business is in its that first third that we're talking about, the expanding stage, there's nothing wrong with being, legally aggressive in, writing off tax deductions and being really proactive in the way that you essentially fund your business and then ultimately invest in the business. And by that, I mean, making sure that you're, writing off a lot of things when it comes to IT, technology, travel, and related within your business that relates to earning income. Quite often, when people start, they're a bit conservative, and they're like, "Oh, take advice of what you can and can't claim." I mean, a good advisor or accountant should be giving you direction on how that is structured and set up in your business and the way that you report that. And also too, just investing in technology, especially, with everything moving as quickly as it is at the moment. I think that's really important in that expanding stage.
Thank you. And in terms of, we've often talked offline about the structure of the the brokerage at that time, and ensuring that the company structure really allows for those growth objectives. Can you talk through that a little bit?
I think now more than ever, especially in the last few months with the changes I was talking about before, the structure of your business is probably paramount. So advice that we were giving today versus advice we were giving 6 to 12 months ago is actually different when it comes to trading structures. And I think if there's something everyone can take away today from a tax point of view, because normally I'm the boring guy that no one wants to listen to, but I think ask your accountant or ask me or ask someone about whether the structure that you have is actually applicable under the current legislation and what's soon to be new legislation, because the old adage of trading through a trust and all those sorts of things is not necessarily prudent nor tax effective like it used to be in the past. So that would be a message I'd give to everyone today.
Thank you. And in terms of just common pitfalls that you see that brokers have at this stage of their business, and conversely, what your advice would be, not only in terms of write-offs and structure, but more holistically, what would you recommend to brokers?
Yeah, holistically, I think, and Nick and I have talked about this, and he mentioned a firm before. I think, in a growing, expanding stage, you can only grow when you've got great resources. So I think what's important is making sure that you have the resources, whether they're onshore, offshore, in your office, working from home, wherever, to make sure you can service the clients. So, broker clients that we have, one thing I noticed when they start out, we have quite a few, is that the resourcing issue, they realise straight away that they're under-resourced. And so making sure that you almost carry a little bit of excess capacity. So when you get that large commercial deal, or you get a flow on some resi deals, because interest rates drop or there's a change in sentiment, which, I'm sure will happen, that you're ready to move and ready to move fast in that regard.
And what would you recommend to businesses in growth, or really any business for that matter, in terms of those discussions with an accountant or business advisor?
Yeah, so I think a common pitfall is, treating your accountant as just someone who's doing some compliance and just getting a tax return done at the end of the year. I think you can jump online and get a lot of different sites to do that for you. What you've got to do is invest time in your relationship with your accountant and your advisor, and be seeing them 2, if not 3 times a year, because you need to be proactive. You need to be proactively planning around, if you've changed from a sole trader to a company, proactive about what the company tax position is going to be for, this coming financial year, as an example. So tax planning Obviously, looking retrospectively on the way you're structured and minimising any tax at the end of the financial year, and also I always say, having that third discussion throughout the year. And quarters come around really quickly, so it's not a lot of time, but just a quality hour, 3 to 4 times a week with your advisor to make sure that you're being proactive, and they're also prodding you and asking you the right questions, because sometimes business owners we can be our own worst enemy.
Do you mean 3 to 4 times a year or 3 to
A
4
year.
times a year? Okay, a week. Okay. No, when you said a week, I was like, oh, wow, that's a lot of accounting time. And I don't know about the people who are listening today. So I have a marketing business, and I imagine that there are a lot of similarities just as a small business owner with brokerages. I almost find that knowing that I'm going to speak with my accountant, and the way that I look at accountants is you've got sort of the bookkeeping side of thing, and then you've got the advising thing. And so the business advisory piece, I think, is what the critical point of this conversation is. But I know that if I'm going to be speaking with my accountant, which I do each quarter, it's almost like that accountability. So I know that I have to have demonstrated the growth or the processes or this or that or the other to then help achieve my milestones. But doing that in conjunction with an accountant means that you're not only forecasting your future success, but you're also identifying any of the potential pitfalls that you as a business owner may not be aware of.
The chances are, if you've got a great accountant, they will have seen it before. Whatever the problem is that you're presenting, or they would have seen it before, and they'll have some advice for you. So I think that's remember that.
Not your first rodeo, right, Justin?
Yeah, unfortunately not.
Okay, so let's move on to more of the mature businesses. We've talked a lot about with the expanding business, obviously just making sure your ducks are in a row and having company structures and all of those metrics in place. For a mature business, I'm interested in your thoughts dual-fold. If there's anything with the mature business specifically that you think needs to be assessed. And the second part of that question is, if I'm a mature business and I want to go back into more of a high growth stage, whether there are any tax adjustments or any difference of thinking for that movement.
So the first part of your question, I think the structure of your, if you're a mature business, the structure of your balance sheet within your business is really important. And people are probably thinking, what's he mean by that? What happens over time in any business is people, lend money to, borrow from, buy assets that may be partly business income producing, not fully income producing, and the business, especially if it's sort of part of someone's lifestyle as a broker, the balance sheet might be a little bit messy. So I think as a business matures and is even in a decline stage, if you are looking to offload part of your asset, part of your trail book, or potentially your whole business, you really should be cleaning up your balance sheet and making sure that you don't have any skeletons hanging around. Another good one is, tax debts. Too often people still just ignore it. The ATO has been really aggressive the last 12 months in that regard. So get things on a payment arrangement to pay them down, because the interest rate that you're now paying compared to what you were 3 or 4 years ago is oppressive compared to where it was. So I think that structure of the balance sheet is really important. And the second part of your question, which was about, if you are in maturity into decline, you want it to ramp back up again. Again, it's just having the systems and processes in place and the governance internally from a financial point of view, and ultimately, obviously, with your clients, to make sure you can handle the growth and capacity would probably be my thoughts.
Okay, great. Thank you. Well, we might move on. So obviously today we're talking about how to use Trail to maximize your growth and strategies to expand your business, whether that's in that first or second third of the chart that Nick showed. So Angus, I'd like to turn to you. So as a Trail finance specialist, I understand that Trail is really moving beyond being associated with its sort of traditional static income stream for life perception, and more to a strategic financial asset that can be optimized throughout a brokerage's life cycle. So I'm interested to understand how that works in terms of supporting business goals and stages. So let's start from the basics. What does it look like to utilize trail as an alternative income? Oh, sorry, beg
Sure,
pardon,
Sasha.
as an alternative revenue stream.
Yes. So, as you've mentioned there, brokers have, worked hard to build up, a successful trail book through that first and second third of the business. And we're seeing, and we want to support brokers and allow them to leverage that steady income stream as a way to secure alternative financing, and being able to do this and access capital without having to sell the book. They're able to preserve personal property, or won't have to pledge additional security that could impact the business. We're seeing, the big advantages of securing finance against your trail income. The interest rates are typically lower than unsecured lending. And it really just allows the broker in those growth stages to really accelerate, and with an acquisitive mindset, using those funds to facilitate growth quickly, being able to pair it as well with the book and the business that you're acquiring. It can self-service the facility, and in turn allows the broker to retain that future upside as your loan book increases. We're also seeing brokers are using facilities or loans secured through their trail in a lot of flexible manners. So whether it's financing those acquisitions, as we've mentioned, using it as working capital, investing in technology and people in particular, as Justin touched on earlier, and debt consolidation as well. We've seen a couple of brokers who may run into some of those ATO payment plans, and being able to use financing of this nature to pay those down and really get ahead at a cheaper rate than the ATO is certainly offering these days. And then to also touch on the budget implications that have come in when succession planning or looking at partner buyouts. We've seen a lot of activity that's sort of really accelerated as a result of this latest proposed budget, where people are looking to bring those buyouts forward, and looking to fund them through effective debt. So by using your trail book and borrowing against that, we've seen brokerages there able to move ahead and bring those plans forward and do it in a really effective and a tax efficient manner.
Thanks for that, Angus. And I think, so I personally wasn't very familiar with this type of funding facility before meeting up with you guys to talk about the webinar. So I think it might be beneficial just to take a bit of a step back. So the alternative funding solution, it's a commercial funding solution. Is it secured or unsecured?
It's secured against the trail income. So in our instance, we are only concerned with the performance of the trail book. We look at that last month of commission, able to annualize that and use that as the value base for what we're lending against. What we've been really trying to do as well is partner with the aggregators, and so really working with the broker and the aggregator in helping brokers grow their business, and making sure that the performance of that trail book that underpins that loan is performing and trending in the right direction.
Okay, fantastic. And so if the broker sells a portion of their book, say for whatever reason that looks like, so I beg your pardon. So if the broker wants to lend against their book, I've been speaking with you too long, Nick. So if they want to lend against the book, how does that work in reality?
So we would look at that. We would look at the trail commission each month.
Yep.
We'd annualize that 2 times, and then we lend up to 70% LVR against that. And that the 70%, and why we sort of sit around there is it gives a lot of headroom for the broker. It's in terms of, if there are clawbacks or sort of one-off things that happen in, the day-to-day operation of a brokerage. It's not overextending the broker, but also giving them a powerful tool in their toolkit to really move the business forward.
Okay, great. And in terms of the loan duration, is this a longer term solution or is this more of a short term funding?
Yeah, short to medium term. So currently we offer 1 to 5 year loan terms. And again, that sort of gives the flexibility for brokers, depending on their needs. The other bit I'll add in there too is again in that lens of really wanting to work with the broker, we sort of are trying to separate ourselves from others out in the market by working with them with early prepayments. So once we sort of move through a portion of that loan, we don't want to punish the broker for growing their business and doing well. It just sort of doesn't sit right with us. So allowing them to pay down early and continue that growth, or bringing in that growth and looking to bring in a bigger facility to really continue that acquisitive and expanding nature of the broker.
Great, thank you. And Justin, I'll throw to you. Obviously, you're very familiar with the finance broking industry. You work with a lot of mortgage brokers. I would expect that you see a lot of different types of alternative commercial facilities. What are your thoughts in terms of applying this type of structure at the moment? And what type of movements are you seeing in industry with the use of alternative commercial debt to support growth?
Yeah, we saw one recently with the guys, it was just really efficient. So I think it comes back to the time frame that you have. In this particular case, I think was for a tax debt restructure. So it comes back to how much time do you have to sort of restructure what you're wanting to do. And quite often, as Angus was saying, from a structural point of view, things can be done relatively efficiently. I think quite often, again, speaking to your advisor about using a family property, to essentially draw down and pay money into or loan money into a business would be something you'd need to take advice on. But we are seeing, especially the last probably 10 years, a lot more clients being really comfortable with, let's call them alternative non-bank options that, as Angus was saying, allow you to access sort of 70% of the value of your book to enable you to do other things.
Okay, great. Thank you. And I might just segue just for a moment to a brief housekeeping matter. The Q&A function doesn't seem to be live at the moment, which is quite unusual. So I want to open it to everyone. If you do have a question, we'd love to hear it, but just use the chat function at the base. Because the Q&A seems to be disabled at the moment, and we definitely want to make sure that we're taking on board your questions. So just go to the chat function, shoot through a question to hosts and panelists, and we'll be sure to talk through that. So let's move on. So Nick, I'd like to talk about some actual scenarios. So starting with obviously Trail supporting growth and expansion through unlocking equity. Talk to me about that.
So I think what we're really talking about today, Sasha, is investing in your business, and whether it's investing to, as Justin touched on, to systems, those sorts of things, whether it's paying down ATO tech, whether it's buying a new business, it all requires capital. So that then begs the question, where am I going to get the capital from? Now, you may be in the fortunate position of just having significant cash reserves that you can draw on. And in theory, they will be the cheapest form of capital that you can draw on. The next cheapest is probably, as Justin touched on, borrowing against your house. We all know about home loans, and if you've got enough headroom in your home loan, it's probably the cheapest place that you'll go to be able to borrow some money to invest in your business. The problem is, of course, is that the bank doesn't want to take security over your house, but that's part of the game. Moving on beyond that, in theory, you can borrow against your business, and there are banks out there who will lend against your business. But typically, if you're going to get anything like what we might call an attractive rate, the bank will want to see a very substantial business, and they'll want to see a substantial loan. So in the marketplace, you've probably got to be borrowing more than about $1 million, and you're going to have a pretty solid business to be able to support a loan that is solely reliant on the business and solely only secured by the business. So it effectively knocks out probably about 80% of the industry in one hit. They just would not be able to support a loan of $1 million plus against solely their business. So we then move to borrowing against your trail book, which is where Angus comes in. So Angus will probably be the next, or broker funder more broadly, will be the next cheaper source of funding. And that's great. You won't be able to borrow as much as some of the other structures that we might have touched on, but alternatively, it may end up being the answer to your issues. The final bit that we want to talk about is using perhaps trail homes, and this is selling effectively part of your trail book or all of your trail book to fund the growth acquisition. And to be quite open, this will probably end up being the most expensive route, but it will be also probably the way that many people will be able to get their hands on the most amount of capital. So cash is the cheapest, borrowing against your house. If you're big enough to go to a major bank and borrow against the business, if you're a more typical broker, to go to somebody like Broker Funder, and then as the final option, if you like, to explore other ways of raising capital via trail homes and selling all or part of your trail book.
Great, thank you. And in the meantime, the Q&A has kicked in, so we're able to see your questions come through. Thank you. So what a lot of the questions are really sort of starting to delve into, and I might throw to you, Angus, to get into this, is we've talked in very general terms in terms of, ATO debt or this or that or the other. Could you give some more micro examples in terms of, obviously not any specific names or any details, but just a micro example of what would it look like? So I'm a broker. I want to buy out my business partner. I want to buy another business. I want to buy this. I want to buy that. How does that look in real terms with figures? And also, I guess the opportunity cost. So of course, people want to know rate, but just understanding sort of an apple for apple situation of that. So if we can sort of maybe just drill down to that next layer down.
Yeah, of course. I might tackle the second bit though. Is that's sort of the bit that people are most interested in is the rate. So typically on that 70% LVR, we're lending around that 15% at the moment. So in terms of unsecured lending, we've been seeing rates well above 20% on that front there, and so we're quite conscious and sort of coming in below that. And pricing it around there too, to then tackle the first bit of the question, in being able to acquire another business or another trail book. So if you, for example, had a broker with 10,000 a month to make the numbers simple here, a 10,000 a month book in trail, and they're looking to buy another book that was say 7,500. So your total we assess both your book and the book that you're acquiring, and so you'd have that total trail book of 17,500, timesing that by 2 and then borrowing up to 70%, gives you just around or just under 300,000 in borrowing capacity. And so if you're looking to buy a book that is doing 7,500 a month, or even more, the multiple that you are purchasing it at, there's plenty of headroom in terms of what you can draw, and then the repayments, what that would look like on a loan to that size. The book that you're acquiring is actually paying the facility off as you go. And so you're effectively, quote unquote, getting the book for free, and over a 1 to 5 year loan term, you then own that book outright, and you haven't had to put any money down, you haven't had to pledge any personal security or look into the headroom of your personal home loan. We've sort of been very sensitive in terms of pricing it that allows for that sort of acquisitive activity.
And in terms of, I know we covered, obviously the broad spectrum of funding requirements, but are you noticing any dominant trends or dominant requirements for this facility?
We've seen a bit of a spectrum, to be honest. You'll have brokers who we've talked about, I've got caught out by the ATO in terms of provisional tax and are looking to get ahead from there. And then, more excitingly, I sort of see at the moment is there's this real sort of coming through of the new broker and changing of the old guard, and this acquisitive activity that's happening with the industry right now is really exciting. And these new brokers coming through that are looking to take advantage of building their business quickly, being able to leverage that asset, being that trail income, and to really continue marching on that path of growth and in accelerating that in a really meaningful way. So in terms of, what it's been, and then the third one I will also say too that we keep touching on here is staying on that, technology forefront and enabling the broker to get out there and operate efficiently within the market, using the facility in a working capital manner, investing in technology and people within the brokerage. We've been seeing as well.
Okay, great. Thank you. And Nick, I might go off piece, as you know, I quite often do. As Angus was talking about this sort of this new guard of brokers and particularly the younger generation coming in, do you see a natural opportunity for brokers who particularly are in that growth stage to start to partner potentially with brokers who are in that succession or they are in that decline stage to really benefit both entities?
It absolutely, Sasha. I mean, it's you can simplistically say for every buyer there's a seller, but it should be a win-win for everyone. So that opportunity of a younger, energetic person in growth mode, partnering up, acquiring, but we particularly like the partnering up with somebody who might have been around the blocks for a while, in that mature phase, maybe even in that decline phase. If you're, starting to see your business actually, oh gosh, my trails are actually starting to exceed my upfronts, look for a younger pup. Look to partner up with somebody that will give you the energy potentially, or at least it actually puts in place a structure where you can formally move out, crystallize a sale, capitalize the goodwill in your business, move it into superannuation, make some proper plans, work with your accountant, work with your financial planner, actually really take advantage of the situation and, capitalize on where you're at. But all too often, there's what I call wasted opportunities. People who should have partnered with somebody, people who had the energy and, I could have, should have, but I didn't. It's you've just got to make plans and you've got to actually pull the trigger and have a go.
And Nick, is that a service that Trail Homes provides if there is somebody listening today that is in a growth phase, who is interested in potentially buying another book or investing in another business, in terms of actually locating who might be potentially in decline? Is that something that you would be able to provide any counsel on?
We can provide counsel. I would want to make it clear, though, we are not a broker of
Yes, of course.
Of mortgage broking businesses. But in fact, one of the things that gives me perhaps the most pleasure is working with brokers to structure up deals, and put them together in a logical way. And whether it's working with Broker Funder or Trail Homes, or we always bring in both the buyer and the seller's accountants to make sure that they're also across the structures and plans that are being put in place, to work as a team and again to achieve that win-win result for everybody. The thing I always say about the mortgage broking industry, it's a great industry because everyone has to win for it to work. And some industries don't actually work like that, but it's Trail Homes and the industry broadly. That's the way we approach it.
Great, thank you. Justin, I might put you back in the hot seat. So particularly if, from what it sounds like, we're going to sort of see quite a lot of market movement based on both the attrition of the original guard naturally occurring, as well as obviously the younger guard coming in. And as Angus was saying, looking at like growth through acquiring books and so forth being one of the primary channels for growth. What would your recommendation be to brokers listening today who are considering that more from a strategic perspective and definitely from an accounting perspective?
Yeah, so from a tax perspective, I think everybody should understand the small business CGT exemptions that I was referring to before. So, if you're a business that potentially um, is in decline, but you're looking to bring on another partner, well, then the 15-year exemption or the retirement exemption, which essentially negates 50% of your gain for tax purposes, is something that you might avail yourself of. Um, uh, Generally speaking, I think understanding, like they say, understand your exit before you start something. So understanding what your time frame is, understanding the laws around that is really important, because I think that the government's backward step on small businesses last week actually showed that they understand that all small businesses, brokers included, are an important part of the economy, and all of our clients, like you'd think about everyone who's listening today, all your clients that own businesses, well, the small business tax concessions are really important from that point of view.
No, definitely. And you also just sparked just an idea or a recollection of what, Nick, I know that you're a big advocate of. And I think from any business owner's perspective, that you do start with your exit in mind. And I know particularly when you are in a younger business that that sounds counterintuitive. But just from the years of working with Nick, and again, whilst I'm not a broker, being a small business owner, that piece of advice is, I find, really crucial, because working to your exit plan allows you to then decide when you want to scale out, when you want to consolidate, and when you do want to exit. So I guess for all the brokerages today, just understanding where your business is at, but also putting into place the measures and having the conversations with your accountant and Justins and so forth of the world to know where you're at, but also where you want to go, to make sure that at each stage you're really progressing the business to its maximum. So I might move to another question. We've had one come in from Sean saying, can you advise or comment on how important alignment is between joint venture partners when a broking firm may, for example, buy into an existing mortgage book held by an accountancy-led financial services firm, where part of the aim is to upgrade the financing function? Tips, risks, and opportunities on this scenario, please. That's definitely going to put you in the hot seat, Justin.
No, is it Nick, or maybe, I mean, this question, I mean, he's got accountants involved, so he's already starting behind the eight ball, because accountants going to over analyze the deal. So you really got to simplify it, so really simplify it down. And we've had situations like this before. Nick, do you want to comment?
I think there's quite a lot seems to be going on in this question of various interested parties, shall we say. The overriding thing in business is always is to make sure that all your parties are aligned. It might be a question that's perhaps better off explored in greater detail and perhaps offline. But the key thing here is you've just got to make sure that everybody's interests are aligned. So clearly setting out what's going to be done, what the aims are, how we're going to grow the business, where everybody's going to have their inputs, the sorts of commitments that everybody's going to make to the business going forward, and to make sure that everybody fully understands what all the players are doing, so that you're not finding yourself 6 months down the road, a year down the road with, I thought he was going to be doing a whole lot of work, and no, I thought you were going to do the work, and I thought I was doing this and you were doing that, and that's when you all start ending up in a mess. But there seems to be, I think, 3 different partners already in this are being mentioned here. So, my alarm bells are starting to ring. We've got to get make sure that everybody's on the same page, to use that old saying.
And maybe, Nick, what this particular example, what they need to consider is actually maybe you should look to one party buy out the other and start again. Maybe this JV that you have, I do tend to agree with you, Nick, that it's a bit too complicated, and it's probably fraught with complication in the future that you haven't foreseen. So maybe clean it up. It's happened before. We've advised on it where either you sell part of the book or you clean it up and you actually then start again, and then put a referral program in place or something like that, where this broker has a referral program with the financial services business, and that might be a much cleaner way of dealing with some of the issues.
And I would totally be with you on that, Justin. All too often we see a sharing of equity. People seem to jump to, a sharing of the equity somehow. Joint ventures that are based on simple sharing of revenue as opposed to everybody participating in the one company are much cleaner. It generally also means that you have a better understanding of, I'm going to refer your business, you're going to give me some money in return. It's cleaner, it's simple, you know where you stand. The sharing of equity is potentially fraught with issues unless you're all perfectly aligned in what the business should be doing.
Great, thank you both. We'll go on to the next question that's come in from Jim. Can you use your company retained profit to purchase a trail book from another book? To Justin, is this a tax effective way as a strategy to grow your business?
The retained profit might sit as a number on your balance sheet, but it's sitting somewhere. It's either in cash, it's potentially money that's owed to you, or it could be a loan, to the business owed by someone else. So the question is, can I use essentially the balance sheet of my existing business to buy another business? And the short answer is yes, but you just got to have the financial capacity or the cash to do that.
And so I guess that would come down to the growth strategy piece, looking at things holistically, opposed to looking at that balance sheet today.
Yeah, correct. And again, I think, too often, and subsequent to these webinars, I've spoken to a lot of people just about, just being happy to talk to them about a hypothetical. In this particular case, again, without seeing the balance sheet, it might be cleaner to acquire a new co. I did it in the accounting space just last year in a new entity rather than in the current existing structure. And there's a number of reasons why. Asset protection reasons, all those sorts of things. So again, be taking the advice and chatting to people about it.
And I think to that point, it's really looking at it not necessarily superficially, but part of a broader discussion point. So again, iterating the point of making sure that that's not in isolation.
Agree.
Angus, I'm going to throw to you. We've had a question come in from Janelle. What documents would be needed to consider funds for a brokerage? So as it relates to broker funder.
Sure. So to answer Janelle's question, we try to keep it as low doc as possible. So in particular, on number one, we're interested in, your last month's commission statement showing that trail income. We'd want to have a look at the aggregation agreement between yourself and the aggregator. In the event of, any ATO payment plans, we'd want to take a look at that. If you're using the funds acquisitively and are looking to leverage the trail book or the target, we'd want to look at the contracts around that, as well as that commission statement to factor into our valuation. But in terms of sort of the documents involved, we as I said, really try to keep it low doc and broker friendly and just hone in on the key elements there.
Thanks, Angus. And in terms of it being low doc, would it be correct to surmise that it's quite a quick turnaround?
Yes. So we aim to move through the credit application process and funding stage in 5 business days. Just to emphasize, so that's our process. Sometimes with all these loans, we enter into a tripartite agreement between the broker, ourselves, and their aggregator. And so that's the only thing that can occasionally hold up the process, but we certainly look to get our side of the fence all executed in those 5 business days.
Okay, great. Thank you. We've had a final question come in, which we'll answer. But before I do so, I am going to go to the panel of what your final tips would be for a broker who is interested in accelerating or expanding their business. So you can start to have a think about that while I put through this last question. So we've had a question come in from Damien, saying this takes into account the business running costs like rent as well, I presume. So Angus, this would be towards you. So if we have 10K per month trail, but 7.5K per month expenses already getting paid from it, then only the remaining 2,500 per month would be the income to calculate the possible lending from.
Correct.
It might be easier having a look at that in the Q&A.
Yes, and happy to sort of take these questions offline as well. But factoring in everything that Damien's put there, we're only really concerned with the trail, and as long as you're using those funds to facilitate for working capital of the business. I mean, if it's going to give you that, that's what we're most interested in. In terms of, as I said, facilitating the operation of the business. We're really just focused on the trail. Of course, the advice, unsolicited advice I give is you don't want to over leverage the business and hurt itself. If you don't have the means to be paying off the facility, then absolutely I wouldn't be looking to to broker funder as a possible solution to that. But to answer Damien's question, we're really focused on just that trail income and the borrowing capacity that allows.
And that's obviously part of a broader objective discussion that I would expect that would be very much sort of fleshing out on a one-on-one basis. Okay, well, we are going to just have to pause for final last words. So, Nick, I'll start with you. What would be your top piece of advice for, pardon me, brokers looking to expand their business?
So I'll go a little bit off piece here. It's all about the sake of this presentation today. It's about how to raise capital. So as I've touched on before, internal resources, your house, broker funder, you'll potentially be able to raise about 1.5 times, maybe a little bit more against your trail book effectively if you work that 70% in 2 times. Through ourselves here at Trail Homes, we have various products in place. So we start to kick in where you'll be able to raise 2 times. You can then, through our buyback option, effectively you can buy that book back again in a couple of years' time. So it's effectively a loan. We then, through our what we call our grow deals, guaranteed runoff, we can potentially go all the way to 3 times. So, if you're borrowing up to 3 times, if you're effectively getting 3 times for your book to invest back into your business, we're now starting to talk about some real capital injections. So we've hopefully given you the machinery, if you like, today to be able to fund the acquisition of your business, whether it be through, as I say, your own resources, broker fund or Trail Homes. We're all here to help you. But the final bit, of course, which Justin, I'm sure, will reiterate, is you've got to have some good advisors around you to make sure that you don't stuff it up. Over to you, Justin. Do you want to pick up on that one?
And, obviously, as Sasha, we work with a lot of brokers, and its structure really is at the moment. In my 30 years of doing this, it really is getting the structure right. So it's not just setting up a company online and starting to train through a zero file. It's actually sitting down with someone for half an hour and actually getting some advice around how you're structured. We talked before about potentially paying out a JV and restructuring the deal, getting the right people around you that have the experience to give you another point of view.
Thank you. And Angus?
The only other thing I know maybe is if you're looking to, grow and expand, being inquisitive and curious and working with, your BDMs within the aggregator and looking for those opportunities, where I can buy books, where I can accelerate the growth of this. And then as the rest of the panel have touched on here, then working, the best way to inject that capital and facilitate those transactions.
Definitely. And I think you touched on a really important point. Having that inquisitive mindset is really a growth mindset. So starting from that place of aspiration, as well as being inquisitive, and as Nick said, having the machinery, you're well poised for growth. Thank you so much to everyone who has tuned in today. We hope you found this session insightful. We'll be in touch with CPD points, with also Angus, Justin, and Nick's details over the next day or so. Thank you again for tuning in, and to our fantastic panelists, Nick, thank you, Justin, and Angus. It's been a pleasure.
Thank you.
Bye for now.
Thanks, guys.